Hey everyone, welcome back to Corporate Decoder. Today, DEUTSCHE DWS Investment Trust just filed their semi-annual shareholder report, and I am seeing some interesting trends in their investments that matter. Quick note, this is not financial advice, just my take on public filings for educational purposes. This report gives us a snapshot of how this giant fund is investing your money. Let's dive into what is really going on under the hood. We are looking at the DWS Capital Growth Fund, and this filing covers the period from the 1st of October 2025 to the 31st of March 2026. Think of this as a mid-year checkup for the fund's investments. They offer different classes of shares like Class A, Class C, Class R6, Class S, and Institutional Class. Each has its own costs and features, but the underlying investments are largely the same. First off, let's talk about costs for a hypothetical $10,000 investment in Class A shares. The costs for these 6 months were about $42, which is 0.89% annualized. Class C shares cost more, around $83 for the same hypothetical investment, coming in at 1.77% annualized. Class R6 shares are cheaper at about $28. Or 0.60% annualized, and Class S shares are just a bit more at $31 or 0.66% annualized. The institutional class also costs around $31 at 0.66% annualized. This shows that how you invest directly impacts how much of your money goes to fees. Now, for some key numbers, the fund has a massive $1,958,952,092 in net assets. That is almost $2 billion. They hold 70 different investments in their portfolio, and the portfolio turnover rate is 13%. This turnover rate means they are not constantly buying and selling everything, suggesting a more buy and hold strategy for some of their holdings. The total net advisory fees paid were $5,101,088. Remember, different share classes have different expense ratios, so this total fee is spread across all investors. Let's see where all that money is going. The fund is 100% invested in common stocks. That means they are not holding any cash equivalents or other assets that aren't stocks. This is a high conviction strategy, all in on the stock market. Sector, wise information technology is by far the biggest slice of the pie at 51%. This is where they see the most opportunity. Communication services comes in second at 15%, followed by industrials at 11%. Healthcare and consumer discretionary are both at 8%. Financials make up 4%, and then smaller percentages for real estate. Consumer staples and materials each at 1%. This heavy tech focus tells you where the fund managers believe the future growth lies. Now, let's look at the top 10 biggest players in their portfolio. These are the companies they have the most confidence in. Nvidia Corporation is their number one holding, making up 14.0% of the fund's net assets. That is a huge chunk. Apple Inc. follows at 9.2%, and Microsoft Corporation is at 8.8%, Alphabet Inc. is at 6.9%, Broadcom Inc. at 5.0%, and Amazon.com Inc. at 4.6%. Meta Platforms Inc. is at 3.6%, MasterCard Inc. at 2.2%, Eli Lilly and Company at 1.9%, and Eaton Corp. plc at 1.5%. These top 10 holdings alone make up 57.7% of the entire fund's assets. This is what we call concentration. When a fund is this concentrated in a few big companies, their performance is heavily tied to how well these specific companies do. So if Nvidia or Apple have a great quarter, the entire fund benefits significantly. But if they stumble, the impact on the fund's overall performance can be quite large. Looking deeper into the actual holdings, we can see how these sectors are represented. For example, in communication services, they hold companies like Live Nation Entertainment, Netflix, Roblox, and Spotify. These are all in the entertainment and interactive media space. In interactive media and services, they own a lot of Alphabet Inc., Class A and Class C shares, and Meta Platforms Inc. These are the big tech giants that dominate online advertising and social media. Under automobiles, they have Tesla Inc. in broadline retail. It is Amazon.com, Inc. and also Home Depot Inc. in specialty retail. In consumer staples, they hold Costco Wholesale Corp. In financials, they're invested in big names like MasterCard Inc. and Visa Inc. In pharmaceuticals, Eli Lilly and Company is a major holding. And when we look at information technology, the semiconductor and semiconductor equipment sector is really dominant, with massive holdings in Nvidia Corp, Broadcom Inc., Applied Materials Inc., and others. This is where a huge part of their investment is concentrated. The technology, hardware, storage, and peripherals sector is dominated by Apple Inc. They also hold some cash, or rather, cash equivalents. They have $8,273,393 in the D.E.U.T.S.C.H.E D.W.S Central Cash Management Government Fund. This is essentially a place to park extra cash safely and earn a little bit of interest. This section, the Statement of Assets and Liabilities, gives us a snapshot of everything the fund owns and owes on a specific date, the 31st of March 2026. It shows investments valued at almost $1.953 billion, plus that cash equivalent holding and some smaller amounts in cash and receivables. On the other side of the ledger, they have liabilities like accrued management fees and other expenses, totaling just over $2.3 million. The net assets, which is the total value of the fund, stands at $1,958,952,092. Here we see the net asset value, or NAV, for each share class. For Class A, it is $110.5 per S-share. Class C shares are at $73.88. Class R6 at $114.04. Class S at $114.46. And institutional class at $114.14. This is the per share value of the fund's holdings. The fact that these numbers are different, especially for Class C, reflects the different fee structures and potential sales charges associated with each class. The statement of operations shows the fund's income and expenses over the 6 months. They earned $5,782,025 in total income. Mostly from dividends, expenses, however, were significantly higher at $8,462,481. This includes management fees, administration fees, and other operating costs. The result is a net investment loss of $2,680,456 for the period. But where they really moved the needle was in realized and unrealized gains and losses. They had a net realized gain of over $195 million. However, the change in net unrealized appreciation on investments was a massive negative $451 million. This means that even though they sold some investments at a profit, the value of the investments they still hold has decreased significantly. Overall, this resulted in a net loss from operations of $258,454,197 for this 6-month period. This is a major hit. This table shows how the fund's net assets changed over time. For the 6 months ending the 31st of March 2026, the biggest factor was that unrealized loss, leading to a decrease in net assets from operations. They also had distributions to shareholders, which further reduced net assets, and then managed to bring in some new money through share sales and reinvestment of distributions. Despite adding new money, the big loss meant overall net assets decreased by about $409 million from the beginning of the period. The financial highlights give us a per share look at performance over several years. For Class A shares, the net asset value per S-share dropped from $134.7 to $110.5 in this 6-month period, a significant decline. The total return for this period was negative 11.59%. Looking at the longer term, Class A had a positive return of 20.37% in 25. But the current period shows a sharp reversal. The expense ratio for Class A is 0.89%, as we saw earlier. For Class C shares, the net asset value also dropped, and the total return was negative 11.97% for this period. The expense ratio here is much higher at 1.77%. Class R6 shares saw a similar pattern with a negative return of 11.46% for the period. Their expense ratio is lower at 0.60%. Class S shares also experienced a negative return of 11.49% with an expense ratio of 0.66%. Finally, the institutional class had a negative return of 11.49% and an expense ratio of 0.66%. It is important to note that while the percentage returns look similar across classes for this period, the actual dollar amounts can differ due to the share price. The notes to the financial statements provide more detail. The fund is part of D.E.U.T.S.C.E D.W.S investment trust and offers multiple share classes. They use accounting principles generally accepted in the United States, which involve estimates. The fund is classified as an investment company. Investments are valued based on market prices. They use a 3-level system, with level 1 being quoted prices in active markets. Most of their holdings, like common stocks, are in level 1. The fund can lend out its securities to earn extra income, but as of the 31st of March 2026, they had no securities on loan. The fund aims to distribute all taxable income to shareholders annually. The aggregate cost of investments for tax purposes was over $765 million, with a substantial net unrealized gain. During the 6 months, they purchased about $299 million worth of securities and sold about $444 million worth. This indicates they were rebalancing their portfolio, selling some holdings and buying others. This section details the relationships with affiliated companies, primarily WS Investment Management Americas Inc. or DEMA, which manages the fund. The management fee is tiered with higher percentage rates on smaller portions of assets and lower rates as assets grow. For the 6 months ending the 31st of March 2026, the total management fee rate was equivalent to an annualized rate of 0.457%. There are also contractual expense limitations in place for different share classes to keep total annual operating expenses within certain percentages, like 1.05% for Class A and 1.80% for Class C. This is important because if expenses go too high, the advisor agrees to waive fees or reimburse the fund to keep them within these limits. This is a really important part. It describes the process the Board of Trustees went through to renew the investment management agreement with DEMA. They looked at performance, fees, expenses, profitability, and economies of scale. For performance, they noted that for the 1, 3, and 5-year periods ending the 31st of December 2024, the fund's performance was in the third quartile of its peer group, meaning it was below average. It also underperformed its benchmark in those periods. When it came to fees, the management fee schedule was considered reasonable and in the first quartile compared to other similar funds. However, the total net operating expenses for classes shares were expected to be in the second quartile, closer to the median, which is not ideal but managed through expense limitations. They also reviewed DEMA's profitability, concluding that it was not unreasonable given the services provided. Economies of scale are addressed through fee breakpoints in the management fee schedule. Crucially, they noted that the fund's performance was below average compared to peers and its benchmark over multiple periods leading up to late 2024. So, what can we take away from all this? The DWS Capital Growth Fund is heavily concentrated in technology stocks, particularly big tech companies like Nvidia, Apple, and Microsoft. Their strategy has led to significant unrealized losses in the current reporting period, contributing to an overall net loss. While the fund has a strong advisory relationship and expense controls are in place, the recent performance figures are a concern. The biggest risk I am watching is the heavy concentration in a few tech giants. If the tech sector faces headwinds, or if these specific companies falter, the fund could continue to struggle. On the other hand, if these tech giants continue their growth trajectory, the fund could see a strong rebound. The fact that the board noted underperformance against peers and benchmarks leading up to late 2024, despite the advisory fees and services provided, is something investors should keep a close eye on. The research tools I actually use to break down these filings are linked in the description. They help keep this channel going. That is my take. Stay decoded.